Hello everyone and welcome to our first episode of Metropodia. Today here we have a guest, Martin Paasi. Hello, how are you doing?
I'm fine. How are you?
I'm good, I'm good. Why don't you tell us a little bit about yourself?
Sure. I have. You could say that I have actually been doing all the capital market jobs that there is. I mean, the only exception is for being an equity analyst that I haven't done. But so basically, I think that's a good thing, so that you know how the interests goes back and forth within the capital markets. And just to be more concrete, I mean, I've been equity trader at Handelsbanken, and I have been doing portfolio performance measurement and attribution. You know, to know what have resulted, what decisions have resulted in what returns. I've been a portfolio manager for index portfolio manager, managing director. I listed the first and still the only ETF on the Finnish stock exchange, the OMX H25. I was a hedge fund manager at Seligson as well. Then I moved to East Capital to become a managing director there, a Stockholm company investing in Eastern European markets. And after that, I worked for. I was a managing director, CEO for Amanda Capital, which was a private equity firm. And besides that, I've been working like a sort of independent consultant for for different financial institutions, pursuing efficiencies, and most recently been involved in mergers and acquisitions within the field of asset management. On top of my role at Nordnet, which is basically being an independent talking head with the license to say whatever the hell I come to think of.
So you also have your own company right now, correct?
Yeah.
Okay.
Recubator.
Yeah.
Like
I read about
incubator, but this is the recubator.
Yeah, it's for like the companies that didn't quite get off on the foot they were supposed to. Okay.
Yeah.
That's really cool. You've actually done like everything you'd imagine there is to do in finance. You were also in Helsinki Stock Exchange at some point. Okay.
Responsible for indices, and actually we were doing the portfolio performance attribution reports there. So for most of the pension companies, so also had the sort of the inside view of whatever the hell these portfolios have been eating at which moments, and how they have been sort of pursuing returns.
Nice. So you have quite a lot of hands-on experience. Our topic today specifically is about digitalization and more so machine learning and artificial intelligence in finance.
Yeah.
Quite a new phenomenon. Well, not really. It's been around for quite a while, but it's getting more used nowadays.
I actually had in the 90s. I when I was studying at Hanken, I bought myself a neural network software called BrainMaker.
Really? Wow.
And it's I'm familiar with the topic, you could say.
Okay, great. That's. I was not sure if you had been that much in contact with artificial intelligence, but it's great. Okay, well, the first question is like, you've had like more than 20 years of experience now. Your first job was the equity trader.
Yeah.
And how has the technology come along, and what were the like largest changes in the industry during these 20 years? And how did you?
I mean, what you have seen is that the traditional equity desks and bond desks at that they have been shrinking, and they are gone. I mean, Handelsbanken used to have the biggest derivatives market maker in Nokia in the early 2000, and now I mean the biggest in the world. And now they don't even have an equity desk in Helsinki any longer.
Wow. Okay.
So it's been sort of tough for everybody in the field, and I would say that this has been the recent developments across the board. It's not only sort of the brokerage part, but also in asset management and private equity and all that. So
where have the people who actually worked as traders or equity management, like where have they migrated to? What, like, when they lost their jobs as brokers, since there was no longer like physical brokerage?
Well, it's a good question. I mean, everybody has been obviously tried to make as good for themselves as possible, but it has been difficult for quite a few people, and I would say that typically or traditionally you had, you went to school, and then most of those that went into the capital market started off by in the trading desk or as an equity analyst or whatever, but in the stock brokerage sort of part of the investment banking business, and that was usually traditionally the place which employed most people. And then if you were any good, you made a ton of money because the brokerage fees were like in the percentages, not like basis points, not like that today.
Yeah.
And if you're really good, you migrated from a stock brokerage part, you migrated into the pension companies or to become a portfolio manager, basically.
Okay.
And for the equity analysts, you might have gone into a corporate, in the corporate world, doing real business and stuff like that. But it's like the next step is like there is exponentially fewer positions, so it has always been like a tough in that sense to advance in the capital markets.
Yeah, fair enough. That doesn't put my future in a great light, but I guess I have to refigure some positions.
Sure.
There's still trader positions there. I'm gonna be okay.
Yeah.
So more on the artificial intelligence and how it affects jobs in financial markets nowadays. Which areas in finance do you feel like are the most vulnerable to these advancements in artificial?
Well, I wouldn't say that they are vulnerable. They're the ones that are gonna benefit the most. I mean, if we think about the quality of service provided, and one of the biggest beneficiaries is client servicing, basically. I mean, you will with proper artificial intelligence and sort of an arithmetic setup, you will be able to service your financial customers better than by doing it with a human.
Yeah.
And the reason is simply that if you walk into a traditional bank and you say that, look, I have this money that I could invest, and then I have a mortgage and I have some insurances and stuff like that. For a person to absorb what you are saying and to really understand and know you, it takes a while.
Yeah.
Whereas for artificial intelligence and a digitalized setup with an arithmetic way of dealing with the client interaction, basically when you come to a digitalized service provider or sort of robo-advisor, it already knows about you more than you even perhaps know yourself.
That's true.
And thereby the setup is such that you can give more accurate, a more customized, and more valuable service to that person. So the customer interaction part is one, and then the other one is obviously portfolio management perhaps in particular, and creation of liquidity in the markets and stuff like that.
Yeah, there's like this high frequency trading that is done purely by like algorithms and robots.
Yeah, because humans are too slow simply. Yeah. But that's true, and I think that the dystopia of having a fully automated marketplace is not that far away. But when talking about artificial intelligence, one needs to take a step back. As I told you just a minute ago before we started the recording, I bought my first neural network software in the 90s when I was studying in the Swedish School of Economics and Business Administration, called Hanken nowadays, but for short. But anyways, so in the early 90s there was this boom of artificial intelligence, and especially neural networks and fuzzy logic. And everybody were thinking that, okay, bloody hell, now it's gonna change. We're gonna be able to produce an sort of algorithm or a way of managing money that's gonna make you rich fast.
Yeah.
And still it hasn't materialized. And now 25 years later, we are back in the same situation. Obviously, there has happened a lot during the last 25 years. But there is one great, artificial intelligence sounds really sexy. And I mean, it's obvious that when we learn to enhance it or utilize it to the maximum, it's gonna be mind-blowing. I mean, nothing short of mind-blowing. But at the same time, we have to be a little bit sort of careful with our expectations, because the problem with artificial intelligence is that it needs to be guided. You need to train it. You need to have input before it starts working.
Yeah.
And in providing that input and in sort of setting up the algorithms that the artificial intelligence then is applying to understanding, and in its pursuit of finding relations between assets and stuff like that, you are already putting in a lot of sort of prejudice in the system in a way. You are already guiding it your way in pursuing sort of further knowledge and intelligence, and that is both good and bad. And the bad part is obviously that you are sort of telling it how to look at the world. And the good part is that you still need to tell something to it, because to make it a simple explanation, for example, if we look at if you get a sort of annual reports, for example, you and I understand immediately what an annual report is. I mean, we know that it's a bunch of papers with a lot of information in it. I mean, a simple thing like that. And but an artificial intelligence box doesn't understand anything. It has no reference. I mean, for you, when we talk about an annual report, you understand that there is a company behind it. And it has a lot of sort of economic and mechanical actions, and all that can be measured in a financial way, and then there's a standardized way of doing it, and it all boils down to an annual report, and then there are certain accounting principles at work and stuff like that. And we all know this by instantly, because we have been growing up in this world. When you take a blank artificial intelligence box, it doesn't understand anything. And it's in order for us humans to be able to utilize it, we need to give it a framework. And obviously there are as many ways of providing artificial intelligence a framework as there are people in the world. So it's not sort of artificial intelligence is sure as hell is gonna sort of really revolutionize things, but it's going to take time, and we're gonna have a pretty busted up, suffering artificial intelligence mentalities around for quite some while, I think.
There's also those are the supervised artificial intelligence computers or programs, but there's also a form of like unsupervised, where you just dump all the data you have in the world. Like you don't do any prejudice for the data, but it runs into whole new problems with what he's trying to find structure in the data, like which are connected. But there might be no real connection or no real correlation.
That is a really good point. I mean, the other problem with artificial intelligence is that it is good at finding relationships, but if there's no causality behind it, I mean, it's worth nothing, because it just have happened so that there has been two things have been moving in the same direction historically, but if there's no causality, there's no reason to believe that will happen again. So it's just a sort of, in a way, statistical illusion.
Yeah, that's true.
And this is a big problem also because of the fact that the applications using artificial intelligence is typically a little bit of a black box. We don't know why it suggests something because we can't sort of monitor it.
Yeah, exactly.
So there is a lot of challenges with it, but and as I was saying earlier, the reference to a mental patient isn't that bad. I mean, I would say that we are narrowing the time in the development of artificial intelligence where we have really suffering intelligences around. Yeah. I mean, to dump all the data in the world in one brain. I mean, imagine what that would do to a human being. You would be schizophrenic, to say the least. And there is, in a way, this analogy is funny, but in a way there is also, I think you need to be very careful with the fact that many artificial intelligence applications are mental patients in a sense.
Yeah, they're really good in some stuff, like in crunching numbers and stuff, but they don't really have the subtleties of a human mind.
No, they don't. But when they get there, they will be very ill before they get well.
Yeah,
and this is my point. And you touched another thing. I think absolutely that artificial intelligence will be tools because they are first. I mean, instead of autonomous thinkers or
that is
managers.
Already the case. A point that I wanted to bring up was Morgan Stanley has already been implementing these robo-advisors for investment managers and investment advisors. They work alongside the people. Yeah. So this has been done for like a couple of years. Yeah. And they're like first persons in this field. However, when do you see this trend coming into the Finland and to the Nordic countries? Like, we're kind of behind the curve on this.
Well, we are and we aren't. I think that in the academics, you can see in the Helsinki University, for example, Aalto University, there's probably a lot of things going on that we don't know about. Due to the recent trend that the financial markets and the entities has been drying up in Finland because there's no point in having local businesses, but rather sort of run everything centralized. I think it's in a way it's not a relevant question because Finns have a lot of knowledge, and we are being employed by these clusters of these hotspots in a sense, where things are happening. But those hotspots are not, to my knowledge, necessarily in Helsinki, and not to my knowledge, certainly not in Stockholm, but rather somewhere else.
Yeah,
because you can run these things from anywhere.
Okay, yeah. So you're not like concerned that Finland doesn't really have implemented this really?
No, I don't. I'm not, and I think that Nordea is, for example, the biggest Nordic bank and even a big bank internationally speaking, who just moved their headquarters back to Helsinki. I mean, that might be one spot where they are certainly looking into these things. They know that they can basically die within 5 years if they don't meet the fintech challenge and really reinvent their sort of existence.
Yeah. Who do you think are in the best position to take advantage of this new technology? Is it like these small corporations or these big banks with a lot of resources?
They basically are both well equipped, but for obviously two different reasons. The smart guys typically understand that, you know, to go and become employed by somebody means that you are always going to be at the mercy of that whomever is employing you. So why not instead become a business owner and sort of set up a startup? And we have Slush in Finland, which is provides everything basically. Flies in capital from the Silicon Valley and Asia, and with Finnair's 350 Airbuses and dedicated airliners. And there's a huge event matchmaking things and all that. So basically, a startup is a good way to go. But then again, obviously, financing is always an issue to some extent, and in that Nordea, for example, who has the sense of urgency.
Yeah.
I mean, that's actually something that we need to sort of congratulate them for. They are very, very aware, and they have a sense of urgency, and because of that, there is also possibilities that Nordea might be surviving all this.
Yeah, fair enough.
When everything comes through.
I think a lot of these fintech startups actually end up like being acquired by these larger corporations, since there's some problems financing them by themselves when they're so small, and it's such a complex market to actually be in.
Well, it's partly true, but then there is like PayPal's and others that are basically good examples of, you know, where it's no point for a bank to acquire it, because it's like, you know, it's counterproductive in a sense. So it depends. And if we have the PSD2 directive that has opened up now recently, beginning of this year, has opened up the information that is in the banking system. I mean, the PSD2 stipulates that as a client, you are allowed to actually give a third person the right to collect all your financial information from wherever they are.
Yeah. Okay.
And that means that there is. I'm actually astonished that it hasn't happened, that there hasn't been a huge breakthrough yet. But I would see that this is actually going to change the way banks work in the future, because what you see is that if you can come up with a startup that collects sort of retail clients all information into one spot and give a meaningful report, for example, even the carbon footprint from your consumption and stuff like this, not to say anything about sort of giving a promise to the client that we will actually compete your mortgage every week, and all the asset managers twice a week. And so forth, to really squeeze your costs, because costs obviously eats up your returns. That would mean that would tend to indicate that everybody who provides for these products, like insurance, asset management, mutual funds, whatnot, they would become bulk providers with really, really, really thin margins.
Yeah, that's true.
So that might change the whole thing, and therefore it's not. My point is that it's not necessarily so that there are any banks in the future.
Yeah, fair enough. Everything is like constantly being.
There are platforms that become very popular because they provide a value-added service to the end user, be it an institution or a retail client. And those that actually maintain the operations become bulk, because a bank account is a bank account in, you know, whichever bank you go to. So that's obviously not gonna be, you're not gonna earn much money on that. But the same goes with funds, and insurance and mortgage it's mortgage. You know, financing is financing. It doesn't matter. I don't care where my money comes from.
Yeah, that's true. Yeah.
As long as I don't, I can minimize my costs.
Yeah. So the next question I wanted to ask you was, is there a threat to finance students being actually replaced by these engineers and people who are more familiar with statistics and stuff that goes into artificial intelligence, especially in the like fund management areas? If there are already funds that are being operated purely by artificial intelligence, and they've sort of matched the performance of active fund managers.
Yeah.
So from what I've read, there's a huge like demand for these students.
Yeah.
So will finance students maybe be replaced, or will the curricula have to be completely done like all over again?
Well, I don't think so. It's like the same concern you had when Henry Ford figured out the conveyor belt production, and then after that with the automation in the industrial productions, generally speaking. It just means that we are doing different things. We are not doing tedious repetitional stuff, but we actually are delivered meaningful data and meaningful insights and from which to make more educated decisions. So I think it's merely a question of the roles are changing, but the students and the human intelligence is still needed for a very long time. But it's like the performance gets better and and all that. So and the work is more meaningful and so I in the transition period there is a lot of pain, obviously, because old farts need to reinvent themselves or take the highway, and the newcomers need to be sort of learning and understanding from the old farts, but also take the lead in pursuing the new sort of frontiers. But apart from that transition period, I see that there is only positives coming out of all this.
Okay. So the characteristics of the work might change alongside, but regardless, there will still be a need for humans actually in the fields of finance.
Absolutely, absolutely. I read some Utopia article about things where you were imagining that. Well, the point was basically that, in short, that there's no point in teaching people to learn maths and physics any longer, but to rather be sort of creative and learn to reinvent themselves and stuff like this. Because in the future, you can ask by just raising a question out loud, you would have some supercomputer in our reference world, a supercomputer basically giving you an instant answer to a very complex question that hasn't been researched before, but it's connected to all the data, and it provides you as a conversational thing, and then you just tweak the question a little bit and then you get a different answer, and you obviously in this kind of a world you will have several careers. I mean, it's like, there are certain needs for that the time spans for certain careers will be shorter. Within a particular field, you will sort of basically have to change the work you're doing, and as a result, you need to be adaptive. That's more important than being a number cruncher as a human.
Yeah, fair enough. That's a good point. So within financial markets, which areas or industries there do you think that would benefit most of artificial intelligence, and which areas can't really use it at all? We have discussed that some of these like front offices of banks will be completely null and void. There will be no more workers after like 30 years. Everything, like if you're going to get a loan or going for investment advisory, you can might as well do it online with the help of a robo-advisor and another human being that can actually help you. But the offices are no longer needed. It's just the back office with the servers and stuff.
Yeah.
Are there any other applications for this artificial intelligence that
I would say that the biggest application is understanding risk. The econometrics of today, the understanding and the computing power, we are just in the brink of actually tapping into unlimited understanding number crunching capacity, a meaningful number crunching capacity. And what I mean with that is that econometrics is about finding statistical tendencies in a sense, and obviously we have been the dumb models and arithmetics tend to sort of ignore the fat tails in a sort of probability distribution and stuff like that, and we will be going forward we will be much better at understanding black swans. I mean, outlier outcomes that might have a very low traditional econometric probability, but still in the real world the probability is much larger, and we will be with these new tools we will be able to grasp these risks better. And risk is everywhere, for the good and the bad. Just to make a point. I mean, if you looked at the Russian stock market between '98 and 2008, it basically had a statistical volatility which was negligent. I mean, it was basically going very, very, very like straight up.
Yeah.
No big ups and downs, but basically just straight up. So the traditional risk measure volatility for that time 10-year period showed that this is riskless.
Yeah.
And obviously it isn't. I mean, and it wasn't, as we know now with the benefit of hindsight. But even then, you knew that Russia is going through a very huge changes from a socialistic market to a capitalistic market. There is political risks and all kinds of structural risks that are underlying.
Yeah, that's true.
That the econometric statistic can't just grasp. And I think that artificial intelligence is particularly gonna be huge in powering the human race in understanding the real measures of risk.
Okay.
So that is one. And apart from more meaningful customer servicing and advisory roles, there might be, you could basically say that in the portfolio management you will be able to, everybody will eventually reach to a certain maximum return because everybody finds out the same truth instantly.
Yeah.
And if you think about it, I mean, now the way you can create excess returns is that you are better informed, or you're lucky, and the mispricing gets sort of corrected at some instant.
Yeah.
But if you imagine that every investor in the universe knows and sees the same thing at the same time, it will automatically lead to the fact that when this opportunity arises, everybody invests in that particular stock, the stock price goes up, and then there is no opportunity.
That's like the efficient market hypothesis, basically.
Yes. So the markets will most probably become even more efficient.
Yeah, that's really understandable.
Which is a very strong case for our cost-efficient index funds and stuff like that. But at the same time, you also will find new products. What we see like factor investing today, it's somewhere in between fully passive market capitalization index-based investing and active management, where you research the equity universe or whatever securities universe, and you try to find sort of characteristics that provide excess returns. And for example, small cap value is one that we know that for the last 88 years it has provided 9.9% annual real returns in the States, at the same time when the US market provided 6.7. So that's, smaller size, price to book wise, cheaper companies outperform the companies that have the opposite characteristics. That is one. Then you have the sustainable, the ESG universe, the sustainable operations of corporations, for example. I mean, apart from the IPCC report that we just got and told us that we will all, the globe as we know it will heat up in 10 years, and we are really at the, this is the 11th hour to do something about it. There's also a lot of research that shows that the ESG or sort of corporations that respect the sustainable aspects of operations they are actually more profitable, and so in other words, ETFs that invest in ESG responsible companies provides a better return. Yeah. So you will find this you will see that the focus goes from having the sort of suit guy with the back slick doing active management. You will move away from that completely, or at least to a significant amount, into index funds and the factor investing kind of universe where you're trying to find
more like these macro differences, that changes that are happening in the economy.
Yeah, then you have the mega trend aspects as well, and stuff like that. But in the end, if we think about the utopia world where everybody understands everything at the same time, you will end up with the stock market being, everybody will agree that, okay, it will give us a return of 7% real return on average, and that's it, and there's no point in trying to beat it, because you will end up with having a small number of active managers that use heavily artificial intelligence to identify these opportunities that will in effect price them out, which will then mean that the index
wins
funds,
again.
Index funds wins again, and it's it's an interesting.
That's true.
Interesting world.
It is indeed. One more question regarding this, like human versus machine in fund management or capital management. I was thinking, do you believe that like human emotion, like understanding the human brain is needed to better perform in these really adverse periods in the market? Like you mentioned Russia and maybe like the mortgage and the dot-com bubble, like 2008 mortgage bubble. So these markets, artificial intelligence would never survive these because it looks at like historical data. And when things happen that have never happened before, it like doesn't know how to react properly. So during these times, is it like more of an asset to actually be a human, or will you just be taken in by the same mania or panic that others?
Well, I would say that it depends. If you have an extremely experienced human, it might be worthwhile, but then typically these are the minority of the market, so things happen that doesn't make any sense. So you end up still being in a mess in a sense. But I would, as I said earlier, I think that artificial intelligence will help us humans understand outlier risk events and to sort of be aware of them and better grasp them altogether. So I think that we will as a whole we will get better. Whom is actually running the show, the artificial intelligence and algorithms versus humans? I think that there will be a terror balance between these two, and they will both coexist.
Okay.
I mean, it will depend on. It's like investment strategies today. It's like there is a lot of contradictory investment strategies out there, and everybody is still being invested in. So
fair enough. I read somewhere that was like 45% of active fund managers or people who are employed in the field actually apply artificial intelligence, and the half don't. So I think
I think that there's a good, really interesting takeaway from this. I mean, if the markets eventually will run into becoming, even the equity markets will be like so that you have 5% of the investable assets are managed by artificial intelligence, that immediately prices out any opportunities to excess returns from the market. That's the story for the index funds. So this kind of scenario highlights the fact that you should be seeking less efficient markets.
That's true.
In order
that's
to,
where the
to
value
be,
is actually found.
Yes, and in the end, you actually end up in being an entrepreneur, because that's that's the source of.
That is true.
Of all value added that the human being produces. And I mean, you can create that value added in obviously endless ways. But on our way down to all of us becoming entrepreneurs, you have emerging markets that are obviously by design less efficient, but then you have also private equity, which is like unlisted companies which are not being monitored by so many, and it's plausible that you can actually get a better information advantage or stuff like that. But point being that in the end, the future portfolio manager of any investments is about sort of finding the startups that have the promise of actually creating huge economical benefits.
Yeah, the stock markets are quite too efficient, at least the large ones, like the American Nasdaq stocks and such like that. They have been researched by hundreds of thousands of people.
Even Helsinki is the Helsinki Stock Exchange is being researched by probably 1 million individuals at any given moment. I mean, it's and this is also again a case for the private investor that, of course, if you have a strong idea of why you should invest in something, go ahead. But I mean, do know that you're not alone.
Yeah,
Even if you don't see these guys, they are there.
Yeah, that's true.
So I think that the takeaway is really that in 100 years, I still think this is going to take a while, but eventually the stock market is going to be so efficiently priced that it's really efficient even from the academic point of view.
Yeah. Okay.
And that means that if you want to pursue higher economical opportunities, you are moving from this super efficient market to less efficient markets, because that's where you have the room to make better investment decisions.
Yeah, that's true. So, in a way, it's a reality to think that within 20 years, like, say 99.9% of stock market activity is actually run by artificial intelligence. Even now, it's like massively run by market making, algorithmic trading, but.
Yeah, but it depends on how you look at it. I mean, if you look trades or trading volumes, they dominate. Yeah. But if you look at invested capital, it's still a sort of a minority. And basically, what high frequency trading is doing is that, the good part of it is that obviously it creates liquidity like hell. But obviously the bad thing is that it's front running you all the time.
It's scalping the prices.
Yeah, so which means that it's also a cost. There is also a cost to it. But if you take the analogy from high frequency trading into pricing stocks, I mean, to finding the true intrinsic value of any given equity, when that is fully efficient, obviously every day the market needs to react to new information, but basically meaning that it's efficient for all practical purposes. You need to focus, if you want to make money, you need to focus more and more on the less efficient markets.
Yeah, true.
And so I don't know. It's how long this is gonna take. I don't know. As I told you, 25 years ago, I looked into the first neural network software. That already in the 90s, fuzzy logic was used in the washing machines. So I mean, this is not a new invention. This is something that we really need to understand. It's not artificial intelligence. It's not a new invention. It has been around already for quite some while.
Now, actually, I think nowadays we have a lot more processing power with these supercomputers with Google that really enables the artificial intelligence to like grow and shine. Yeah, and maybe we'll probably see some great things come out of it. And we already have a lot of like car designs, like it doesn't break when you collide it, or actually the person inside actually stays alive and such.
But I mean, then again, I would absolutely steer away from this folly. I mean, why on earth have the artificial intelligence paint a picture? I mean, it doesn't get any pleasure out of it, and it's not the point. I mean, you should use artificial intelligence where it's useful. Yeah. And I think it's extremely exciting. It's an exciting time to be alive as a human being right now. With the developments in digitalization, artificial intelligence, in the biotech field, there's a lot of things going on, and I mean, internet is such an old invention, really, and I mean even the Google and the Amazons and all that is even in the modern times, they are old. They are more than 10 years old. I think that all the new things are going to be even more rapid and shorter lifespans on everything.
Yeah, that sounds realistic. Yeah.
Well, I don't know about that, but I think so.
Yeah, we'll see. Only time will tell, I guess. I mean, Google had these neural networks that have already beaten the best of the world in chess and Go, these board games, but the main difference in those, there are like clearly defined rules, and they can actually study the game and all the positions and how this works. But in stock markets, there's actually a rule breaking. People do fraud. How do you make a machine understand, like, wait, hold up, this isn't, you're not behaving in the way you should be behaving, like this company should not have this much money and so forth.
If we have time, I mean, I could also, there's when you, this was actually what I was going to also to answer to your question with regards that do I think that it needs to be a human to understand stock market crashes. I think that when enough artificial intelligence is running the stock markets, there will be no stock market crashes to the same extent. Yeah. But at the same time, the stock market crashes are simply, I mean, that's sociology. I mean, that is group behavior. Purely, yeah. And that is that is fuzzy logic and illogical. And it's not the crash itself, which is the illogical part, but it's whatever
happened before the crash.
Happened before the crash that is the illogical part.
Yeah, that's true.
And hence, I think that when we get smart enough artificial intelligence managers, they will sort of see this and they will start to short stuff, and the quality of management will become better.
Yeah, that's a really good point.
Yeah,
I think we've pretty much gone over the main key points here that I wanted to discuss in this podcast. Short plug for the Rahapodi you are doing for Nordnet. You should really check it out. Do you have a website you can actually, do you remember the URL?
Yeah, well, now it's it's like nordnet.fi/rahapodi.
Yeah. Okay. So you can find a lot of similar content with a little bit funnier guy instead of me, and a different environment and some cool guests. But
and the white sheet.
Yeah, I mean, I prefer the black sheet, but if you're more into the white
cooler.
sheet, you should actually look into.
Yes, I agree.
But yeah, that's really cool. You should check it out. But thank you for listening, and we'll see you next time.
Thank you.
Thank you.